Shall we start? Are you ready? Any questions before we start? Do you have any questions? Have you tried the questions on time value of money? Okay, if you don't have any questions, I'll go back to one of the examples that we did and I asked few questions and left it there for you to think. But I gave the final answer. That's on the annuity due. We did an example on annuity due and discuss how to calculate the future value. Can you remember that? Can you see the board?
Yes, sir.
Yes, sir.
Okay. What is an annuity due?
First cash flow.
Sorry?
At the start of the period.
What is an annuity? What's an annuity?
Sequential cash flows.
Equal size cash flows, not on equal size, in equal intervals. Then what is an ordinary annuity?
The cash flow occurs at the end of the interval.
Cash flow occurs at the end of the time period or the interval. Then what is annuity due?
So it occurs at the start of the
Yes,
time
yeah,
period.
the cash flows received or paid occurs at the beginning of the period. So we did an example of annuity due, assuming 10,000 rupees in each period for 5 periods. This is time 0. We receive the first cash flow now. Then our problem was how to calculate the future value. How to calculate the future value. The first question, or one of the questions that I asked, whether we are going to calculate the future value as at this date or as at this. If we have to calculate the future value as at this date, that means at the end of the 4th year. But if you have to calculate the future value as at this, what does it mean? That is the at the end of the 5th year. So depending on that, your answer may vary, and the Excel function gives you the answer as at this date. So how can we calculate this value? What we did, what we have to do, either you can calculate the future value of each and every cash flow. That can be done. You can calculate future value of each and every cash flow using the equation clear. Calculate the future value of this. If you have to calculate the future value of the very first cash flow as at end of the 5th year, then we have to calculate n is as, we have to take it, n is as 5. Correct? Then for this one 4 likewise. But if we have to use the annuity equation, how can we do that? Still we have to calculate the future value of the first cash flow using this equation. Here we put 10,000 1 plus, what was the interest rate we considered last week? Is it 9%?
Nine percent.
9%. Okay. 0.9. Whatever the answer. Then we consider all these 4 as annuities. And remember, if we use, what is the equation for the future value of annuity? Future value equals A over R What's the equation?
Future value equals to A into 1 plus R to the power n minus 1 divided by R.
1 plus R
Minus 1
power n minus 1
divided by R, but not A divided by R. A into whatever.
same thing. This
Yeah.
is, we can write it as 1 plus R to the power n minus 1. We can take out this R out because it's common.
Yes, sir.
So either way you can remember it. So this is the equation. If we use this equation, we get the future value of these cash flows when? At the end of the 4th year or at the end of the 5th year.
End of the 4th year.
We get the future value here of all these cash flows, all these 4 cash flows. But this equation is valid for ordinary annuity. So in that sense, we assume we are here. We receive cash flows at the end of first day, at the end of second day, at the end of third day, at the end of 4th year. So therefore, we receive the future value at the end of 4th year. But we need future value at the end of the 5th year. Then what do you do to calculate this FP2 of just future value of only these cash flows, but at the end of the 5th year? What you can do?
From
You
the
can-
4th year, we are calculating.
Whatever the figure that you get here using this equation, you can calculate the future value of that figure for after another 1 year, isn't it? So you get the future value here, but you need the future value at the end of the 5th year. What you can do, whatever the figure you get here, you can calculate the future value of this figure after a 1 year, 1 more year period. Okay, you move forward for another 1. Is it clear? Why we can do that? We can consider, instead of 4 cash flows, if I denote this future value of all these cash flows, as FP1 at the end of the 4th year, we can consider, instead of a series of cash flows, there's a 1 cash flow at the end of the 4th year, which is equivalent to FP1. We have a 1 cash flow at the end of the 4th year. The value is FP1. Then we want to find the future value of that cash flow after 1 more year, or from beginning after 5 years time. What you have to do, calculate the future value of this for another 1 year. So then that future value, FP2 may be, or should be, FP1 plus 1 plus R. Clear? Then we get the future value of these 4 cash flows at the end of the 5th year. But to get the final answer, we have to add this part as well. What is this? What is this FP1? Considering ordinary annuity. This is the future value of ordinary annuity. We calculate future value after another 1 year, right? This is the future value of the first cash flow. Is it clear? Or you have any questions? Any questions? No. Okay. If not, let me ask a question. Assume there's a 1 cash flow at this point. After 3 years, there's a cash flow of 10,000 rupees. 1 cash flow after 3 years, 10,000 rupees. What is the future value of this cash flow after 5 years from now? What is the future value of this cash flow after 5 years from now. We are here today. In 3 years' time, 2024, we expect to receive 10,000 rupees. We want to find out what could be the future value after 5 years from now, that means in 2026, future value of this cash flow in 2026. What is the future value of this cash flow in 2026? Assume interest rate 9%.
Is it 9,394.78?
9,000.
9, yeah.
11,800.
First tell me the 10,000.
394.78.
394.78.
0.78.
The answer 11,000.
881.
881 point. No sense. That's it. Exactly. Okay. Assume this is an multiple choice question. You are given only two answers. These two are the answers. Okay. This is the question, and it's a multiple choice question. You are given these two answers. What's the answer that you select?
Sir, I'm sorry, sir, it should be 11,881.
Yes. Why it cannot be this 9,000?
No, it cannot be less than 10,000 because I
It cannot be
calculated
less than
wrong.
10,000 because this is the present value. When the interest rates are positive, future value should be more than that. So those are the things that I am telling. You should have some sense about what you are doing. The moment that you see this answer, you should realize something is wrong. But saying that, I'm not saying this is correct. I don't know. But apparently it's correct. At least the direction is correct. Clear? So I hope this is correct because you got the same answer. So how did you get this answer?
First, we calculated the present value from T0.
Present value?
Yeah, for the 10,000.
10,000. Okay, you can come back, calculate the present value.
Then go reverse back, sir, for the future value.
Then move forward to calculate the future value. Anything else? Any other way? Is it the way that you all Follow? Others? Any other answers? Sorry, I cannot hear you.
First, you can calculate the for the fourth and then fifth one.
Can you speak loudly?
First, you calculate for the fourth end of fourth year. Then after calculating that to fifth year.
So what do you mean? What do you mean? Calculate the future value at this point and use that to calculate the future value at this point. Is it your answer?
Yes.
Yes. Okay. Any other methods? No other way of doing that. Both are correct. Both are correct. You can do that, but that's not the easiest or the straightforward method. What you have to do?
We can use annuity. We can use annuity equation for further 2 years by considering T3 as 10,000.
Annuity equation. Definitely, you cannot use annuity equation because there's no cash flow here. To use the annuity equation, you need a series of cash flow.
Also, we can use simple future value formula for next 2 years.
Yes, you can do. Use this equation where n equals 2, r equals 0.09, pv equals 10,000. You can do that. Just calculate the future value after 2 years. Same thing, when you come back and go forward, you will end up with this equation. Here also what you do, the same thing, compound for 2 years. Clear? You can try in different methods and see whether you get the same marks. You should. Any questions? I'm going to stop this and move into the new topic. So before we move into the new topic, if you have any questions, please ask it now. Any questions on future value and future value, present value, annuity, or
Excuse me,
simply?
sir.
Yes.
So in the annuity due, can't up to the end of the year, like treating as a normal annuity. So we calculated for the first year present value, future value. Then we took up to the 4 year, and we again calculated for the 5th year. No, can't we take it as a from T1 to T5 for the end of straight away?
No, the example we discussed is at is an annuity due. So then we receive the cash flow
Okay.
at the beginning of the
Okay.
period.
For the
Then-
balance, can't we?
No, not only the first one, even the other cash flows received at the beginning of the.
Right.
That's
Okay,
why
I got it.
that's an
Okay.
annuity due. Not only the first cash flow,
Okay.
all the cash flows are received at the beginning of the time period.
Okay. Okay. Thank you.
Okay. So, see, that's the good thing that you are asking question. Now I can see there are some misunderstanding about what is an annuity due. In an ordinary annuity, we assume all the cash flows are received at the end of the period. In an annuity due, we assume all the cash flows are received at the beginning of the period. Clear? So, if you are not clear about these two, you can't perform any calculation. You will mess up with everything. That's what has happened apparently. Okay, any other question?
So
Any
can't we discuss second question in that question practice questions paper?
We can. The thing is,
Time no.
time, yes. Can
Okay.
you?
Okay.
No,
Then
okay.
it's okay.
No, but on the
So
other
I
hand,
also suggest the same. Sir, excuse
but
me.
yes.
Sorry for. Yeah, Mr. V. I also suggest the same, sir. To
At least
discuss.
at least one question per day.
So what's the second question? You are retiring today and must choose to take your retirement benefits either as a, oh, shall I share this? Can you see the Word document? This is the question. You are retiring today and must choose to take your retirement benefits either as a lump sum or an annuity. You are given two alternatives, an immediate lump sum of rupees 2 million or annuity with 20 payments of rupees 200,000 a year with the first payment starting today. The interest rate is 8% per year compounded annually. Assume no tax in either case. Which option has the greatest present value? What do you have to do? Without putting it into numbers, tell me what do you have to do? Once you read the question, you should understand.
Lump sum?
Huh?
Lump sum
You
amount?
have to
The answer. No, I'm not asking the final answer. But I'm asking now, what do you have to do? What is the
You.
what is asking in this question? Very first thing that you have to do something. Then only you can come to an
Future
conclusion.
value? Future value?
Future value.
So
Present
this is
value.
the annuity due,
Present
right?
value.
So present value of the annuity due.
Yeah, first thing that you have to calculate is the present value of the annuity due.
Usually, both options.
Then what do you do? First thing,
Compare-
calculate the present value of the annuity due. Then you compare it with the lump sum or the alternative. That's the alternative. Either you receive that lump sum or get the annuity. So how do you compare that? Bring all these cash flows into a one point in a time. So in this case, we bring it to today, present value. So calculate the present value, then compare it, which gives you the highest present value. Clear? That's what you have to do. Now I'm pretty sure that is the part that you cannot understand. If I ask straightforward, there's a 200,000 per annum annuity due. Interest rate is 8%. Calculate the present value. You will do that. Is there any difficulty of doing that? Can you do that? Calculate the present value of annuity due. You have to answer me, otherwise I don't know whether you can do it or not, because I can't see what you are doing. Or do you have to do that part as well? So what's your suggestion? Basically, in this example, there's an annuity due, 2 million at the beginning of each year. So what we have to do, calculate the present value at this point. There are 20 cash flows receiving at the beginning of the period. How do we calculate the present value of this annuity?
So payments are 200,000.
Sorry, yes, payments are 200,000. 2 million is the lump sum. Every year we receive 200,000 at the beginning of the year. So this one we receive immediately. What is the present value of that? It is same as the payment. Then there are another 19 cash flows remaining into the future that we can consider as an annuity, ordinary annuity, because we are here. We receive this one at the end of the first year, that means beginning of the second year. Likewise, so we can consider it, but then there are only 19 cash flows. We can use the present value of the ordinary annuity. What is that equation? A over R. What is the present value equation for an annuity?
1 minus 1 divided by 1 plus R to the power n.
What is this A? It is the very first cash flow that we receive. What is this part? It is the present value of all these cash flows. So you plug the numbers here, 200,000 plus 200,000 divided by 0.08. Remember this, it's given as 8%, you cannot write 8 here. 1 minus 1 plus 0.08. Now what is N?
19.
19. Then the rest is up to the calculator. Is it clear?
Yes, sir.
I think the problem that you have is to identify what to do.
Yes, yes.
So that is that's the application, that whatever theory you learn, you should be able to adapt it into the situation. Okay, shall we move into the new topic, or do you have any other concerns? But now you can see, the more the questions that you ask, it's better for you, because now I'm having a difficulty here. I cannot see what you are doing. If you were here, I can see what you are doing, and I can see your faces. Then I can understand what's happening there. Now I don't have that. So therefore it's difficult for me to gauge what is your level of understanding. So the best thing, you ask whenever you have question, please ask and respond to my questions.
Can anyone tell the answer? Then we can compare it.
2,120,719.82.
1,927,190.
In 1 million.
Yeah.
Yes, the present value of annuity is 2
Sorry,
million
it should be 2,100,719.
Yeah, that's correct.
2 million, sorry. $2,120,719.84.
Yes,
Yes.
sir.
Yeah, that's correct.
So can we have the answers for the other questions as well? Then we can compare with them.
Okay, I'll let you know. Yes. I haven't put it here. Okay, I'll do that. Yes, I'll do it. Anything else? Shall I start this?
These equations are given at the exam or?
No. You have to remember. Anything else? I think not giving the equation is good for you. If the equations are given, you don't study the equations. You just think, okay, the equation is given, nothing to worry. You come to the exam and you see the equation, but you don't know what are the terms. What is R, what is N, what is M, what to do. Any questions? Shall I start this topic, new topic, money markets?
Okay, sir.
Okay, you can see the presentation now. And you have the handout with you.
Yes, sir.
It was posted. One more thing, still I can see some are login without going through the account provided by IBSL. So it's better to use that account. Few things, then you can straight away you can access other materials even during the class. The other thing is, time to time there are pop-ups coming here asking us to admit those people to the class, so it will disturb me here. So better you use the account, IBSL account, first log in to that account and then through that join the class. Okay, money markets. We know about money markets, we discussed a little bit. So these are the contents that we are going to discuss. What is the role of money market segments? Who are the participants? What are the instruments? That's the most important part. And under these instruments, treasury bills or other government securities in money market, very rare, any other thing, the interbank market, commercial papers and repurchase agreements. Those are the base products that we are going to discuss under money market. So you know what money market products or the money market, we refer money market as the short-term market, to exchange funds for a short time period. Generally we call it as less than 1 year. Any instrument with a less than 1 year maturity, we call them as money market products. generally in any country, money market is highly liquid. Short-term products are highly liquid. What does it mean by liquidity here? You can trade those instruments without having any impact on the market price. And thus, since it's only for a very short period, risk is low. It doesn't mean that there's no risk, but it is low compared to the capital market products. So where we use money market, so as we discussed, especially in the banking sector, there may be banks with surplus funds and there may be banks with deficits. So each other lends and borrow money in this money market. The government does the same. Whenever there's a short-term requirement for government to fund its budget, the government uses the money market, especially the Treasury Bill product. And the bank certificate of deposits issued by banks, that is also to raise funds for a shorter period by banks. Commercial papers, which is equivalent to Treasury bills, but issued by corporates to fund their short-term requirements. They use commercial papers. That's the difference between Treasury bill and a commercial paper, only the issuer. Treasury bills are issued by the government, commercial papers are issued by corporates. In between that, banks we don't consider as corporate or not the government. Banks are special. So bank uses a different sort of instrument which is called certificate of deposit. So all these things I think you know, no need to explain very much. Then the federal funds. This is just to give you what is happening in the international market. Fed fund is the applicable market in the US, United States. That is the market where US banks exchange funds among banks for a short period. That is the market in the US for US banks to exchange funds among themselves. The equivalent of that in Sri Lanka is we call interbank call money market. Among banks, they lend and borrow basically on an overnight basis. That is we call interbank call money market. We call it as call money that because most of the trades are done over the phone. You call another bank or a money market broker and do the transaction. So that's why the call money word is there. And then other product, most very important product is the repurchase agreement. So central bank uses repurchase agreement. Banks use repurchase agreement to fund their deficits or to lend excess cash. We'll discuss each these products in detail later towards the end of the topic. So basically the role is...
So I have a question.
Yes.
So just for clarification, when we talk about the money market, in the market, always we are talking about the Fed funds. Though it is not in Sri Lanka, that is globally, is it some kind of importance is there? Why we are talking Fed funds always in the treasury or somewhere else, Fed meeting dates, and is there any influence to the global economy from the federal funds, or if there's any other reason?
There's a influence because what is the interest rate in US? What's happening there? It is very important. So that will give us some indication about the global economy and fund flows, whether dollar will appreciate or depreciate, things like that, because it's the largest economy in the world still.
Right. Thank you, sir.
Yeah. There are overflow effects even to small countries like us. So the role of the money market is, so as I mentioned, there are deficit units and surplus units. But the surplus is only for a shorter period. Deficits also for a shorter period. So to cater these requirements, the money market is there. So those who have surplus funds for a shorter period can lend to those who need funds for a shorter period. So that is the basic role of the money market. But it plays a vital role that provides the liquidity to the system. Because as I mentioned, especially banks, they borrow for short period and fund long-term projects or provide long-term financing. So there's a gap between assets and liabilities. To match that gap, the banks should be able to borrow in the short term. So this money market, especially the call money market, provides a good liquidity into the market. If the market liquidity is not enough, then the central bank comes and provide liquidity. On the other hand, if the market liquidity is too much, then the central bank comes and absorb that liquidity.
So, so what happens when it's too liquid? Like, I can understand why there's an issue when it's not liquid, but what is the issue then it's too liquid? Like,
So what's the issue in?
If it is more like excess, if there's excess liquidity,
then what would happen? Interest rate will drop drastically. Then there will be fluctuations in the interest rates. No stable. Interest rate is not stable. That's the problem.
okay.
Whether two things. One is whether interest rate is high or low. That's one concern. Which one is good? Whether it's high or low, whether it's stable, whether it fluctuates very frequently or remains or fluctuate only within a narrow band. Which one you prefer? Today interest rate is going to 6%, next day coming back to 3.5%, again come to 5%, going down again to 3%, again going to 7%.
So
Would you like,
stable
you don't like that. You need a stable market. That's the reason. Yes. So basically money market facilities all these functions, fundraising, but again it's for only for a short period. You can consider it as cash management. You have cash or you need cash. How do you manage those requirements? On the other hand, you manage risk as well, your liquidity risk through your money market. Not only that, you can do speculation as well. What does it mean by speculation? You take a view on the market, on the interest rate. You either borrow or lend based on your view. If your view is correct, you will realize a profit. If your view is incorrect, you will realize a loss. And signaling, that's the thing that one asks about Fed. Why do we follow Fed fund rate and the Fed FOMC and things like that? That gives signals. What is happening in the market? Where whereas the interest rates are moving, whether it's upward or downward, or it's a volatile period. If it is volatile, why? Things like that. And most importantly, it provides access to information on prices. So what would be the treasury bill price? Then what would be the 3-month deposit rate or prime lending rates, things like that. And no need to say, here we are discussing wholesale markets where we transfer large volumes. Even in Sri Lanka, there's a large money market in Sri Lanka.
So that is speculation and position finance is same, no? In the nature?
You carry a position because of speculation in a trading
right.
position.
So what is his prime lending rate?
Prime lending rate is a bank lends to a prime borrower. So good quality borrowers.
Okay, thanks.
So if you have to talk about money market segments, again, we can segregate into different segments in different using different characteristics. However, there may be overlaps. Since we use different characteristics, there can be overlaps. But considering these characteristics, we can break into different segments. First thing is interbank market. As I mentioned, this depends on who are the participants. In the interbank market, basically in Sri Lanka, only the banks participate in the interbank market to provide liquidity or find liquidity. In the primary market, again, primary market, it's not only applicable for money market. You know that there can be primary market for the capital market instruments as well. What does it mean by primary market? That where any instrument is issued for the very first time. So borrowers raise funds. That is the primary market. So even in money market, there can be a primary market. Treasury bonds, that's a capital market product. There can be a primary market. And even in equity markets, there's a primary market. So this is not something unique to the money market. But still we can segregate if you need primary market or primary money market and secondary money market. What is secondary market? We discussed this in general. Secondary market where we trade existing assets or existing instruments issued by a borrower previous. So now in the secondary market, these instruments or the assets are traded among investors, not in between the borrower and the investor. But in the primary market, trades are taking place between the issuer or the borrower and the investor. Then the fourth category is derivatives market. Again, derivatives, there can be derivatives with very short maturities, less than 1 year maturities or more than 1 year maturity. So again, the derivative market itself can be divided into money market or the long-term market. That's why I mentioned that these are not clear or the segments applicable only for money market. In general, we can segregate into these categories. So basically, these instruments can be divided into these three: treasury bills, interbank loans, deposits, and other bank liabilities. Then the repurchase agreements, or if there's any similar collateralized short-term loans. And from the corporate side, as mentioned, commercial papers issued by non-deposit entities. That means parties or the corporates which cannot take deposits, they issue commercial papers, certificates of deposits, basically issued by financial institutions. These euro currency instruments, this is again key in the international market. I think I explained this. What does it mean by euro currency? Is it? What does it mean by euro currency? I think I explained this last week when we discussed about day count conventions. Can anyone remember what is euro currency?
The instruments which is using in European countries in money market.
Basically, an instrument denominated in a currency
Other than euro.
No, but
Other than home currency, right?
yes.
Other than home currency, yes.
Other than home currency or home country. So the instrument is denominated in a currency and traded it outside the domicile country. Dollar instruments traded in European market or somewhere else, we call them euro dollars. Yen traded outside yen, we call them euro yen. Sterling pound trade outside UK, euro pounds, likewise. So those are euro currency instruments, because even in a local treasury you have your nostro balances and foreign currency balances. You have to manage them. You don't keep it in the idle form in an account, nostro account. You place a deposit or you try to make some income out of that. So in that you need these euro currency instruments. Then the last one is interest rate and currency derivative instruments, which can be used in the money market either to speculate or to hedge your risk. So in today or under money market, we are not going to discuss any derivative instrument which we can use in the money markets. We'll discuss all these when we are discussing derivative instruments. But basically, under this topic, we are going to discuss about treasury bills and repurchase agreements and commercial papers. So characteristics, as I mentioned, these are short term and low risk and highly liquid. You can sell or buy this instrument, most of these instruments, and any time, or since the maturity period is very low, you can consider them as highly liquid and they are very close to money. It's not same as holding money, but very close to money. If you keep money, you don't earn any interest, but in the money market instruments, you earn some interest, but it's very close to having money. You can liquidate your investment, most of the investments, and get money back, or what you have to do, wait only few days and realize your cash flow. Then you have the liquidity. That's why it says close to money. Again, money market instruments, not only money market instruments, even other capital market instruments, we can divide into two categories: tradable instruments and non-tradable instruments. What is a tradable instrument? Where we can negotiate a price and transfer the ownership to another party. Only the tradable instruments that we can trade in the secondary market. Clear? Tradable instruments are where we can transfer the ownership of that instrument. So examples are Treasury bills. Through the primary auction, I can buy the Treasury bill. Next day, if I don't want to hold it, I can sell it to some other investor. So I can transfer the ownership to someone else. Treasury bills, commercial papers. But in certificate of deposits, there are two types. There are negotiable CDs and non-negotiable CDs. So only negotiable CDs are tradable. That means they can the owner can sell it to someone else. Negotiable certificate of deposits. In the non-tradable instruments, it's the opposite of tradable instruments, where you cannot trade or you cannot transfer the ownership. If you buy that instrument, you have to hold it until maturity. So repo is one sort of product. Once you enter into a repo transaction, you have to wait until maturity to get your funds back or to repay your liability. Interbank loans are almost are the same. You have to wait until maturity, and non-negotiable certificate of deposits. So you cannot transfer the ownership to anyone else or go back to the bank and give it. You have to hold it until maturity. In the money market participants, here I have listed even participants, those who can participate in retail market as well, but they can participate in the wholesale market as well. Ultimate lenders, the individuals, those who have excess funds for a shorter period and they want to make an investment. And the ultimate borrowers, individuals, there may be individuals, those who need funds for a short period. And the intermediaries. Here, intermediaries are like brokers or dealers or investment bankers. They don't borrow for themselves or they don't do investments for themselves. But what is their role is to bring borrow or meet borrowers and lenders. So even in the interbank market, as I mentioned earlier, money market brokers are involved. Whenever you want to borrow, you don't directly call another bank and say that I want to borrow. You contact a money market broker and inform the broker about your requirement. Then he will go or scan the market, other participants, and see who has money and to suit this requirement and bring that party to the transaction. So that's happening. In the dealer also, there are different types of dealers. One type of dealer is they just do a transaction on behalf of a customer, not for their own books. Investment bankers, their role is to launch or issue commercial papers, things like that. They facilitate or provide facilities for corporates to borrow short-term funds. Then the government, most of the countries' governments are the major borrowers. Government borrow for short period. Central banks not borrow to fund to central bank balance sheet, but to maintain the liquidity in the market. So therefore, central bank may borrow funds from the market or lend funds to the market. Then the credit institutions, that is banks and other financial institutions, they give loans to customers and corporates. And there can be other financial intermediaries such as money market funds or endowments or superannuation funds, insurance companies, things like that. They also participate in the money market, but most of them are providing liquidity. So that means they lend. Mostly they lend rather than borrowing. And ultimately, large non-financial corporations, to fund their requirement, they borrow funds for short period from the money market. It can be direct borrowing from through a bank, or maybe issue in a commercial paper or any other instrument like that. So maybe a private placement. For a corporate to borrow, investment banker can help. So investment banker can find out some investors, those who willing to lend to a corporate without going public. So investment banker can facilitate that. That is we call a private placement. That is a transaction between the corporate and the investor. Then it would become a non-negotiable product or non-tradable product. Investor cannot transfer that ownership to someone else. Then treasury bills. So from this point and onwards, again, pay attention, very important. You have to understand the characteristics and nature and the economics behind these products. So we are going to discuss treasury bills and characteristics of treasury bills. How do we price treasury bills? Then same concepts we can apply for commercial papers. Then we are moving into repo transactions. So what is a treasury bill? What do you know about it? Please let me know what do you know about treasury bills.
It's a value fund, in funds for the government.
For a short term period.
Yes, treasury bills are issued by the government. What does it mean? The ultimate obligation is with the government. On behalf of the government, central bank issued, but the ultimate borrower is the government to fund their short-term funding requirement. So what else that you know? Is it a tradable or non-tradable? Can it?
It's tradable.
It's a tradable. You can transfer the ownership to someone else. What are the characteristics that you know? What are the maturities?
It's 91 days, that is 182 and 364.
Yes, in Sri Lankan market, it's 91 days, 182 days and 364 days at the time of issuing. Remember that. If government issue a treasury bill on next Wednesday, it will be settled on the next Friday. At that time, the maturity would be 91 days or 182 days or 364 days. But after another week, the maturity period is not 91 days, but it's lesser by 7 days. That means only 84 days. Likewise, at the maturity or the original maturity of the instruments are limited to 91 days or 182 days or 364 days.
So day count starts from the settlement date.
Yes, day count starts from the settlement date, because only from the settlement dates the interest accrual is started.
If it is less than original date, that means it is at a discounted price, no?
I didn't get that.
If it is lesser than 91 days, that means that you will not get the original interest rate, no?
That depends. That depends at what price you purchase it.
Right.
So we'll
So it's
discuss. Yes.
always dirty price. Oh,
So sorry, I didn't get that.
is it always traded at dirty price, right? Like with the interest rate?
Always traded at dirty price. Okay, good. Good question. Treasury bills. Is there any interest?
Always traded at clean prices.
No, my question is there any interest
No.
for treasury bill?
Zero coupon.
Yes.
But still, there's going to be some like you're getting the coupon value, like the full value at the end, right?
Yes. So that did others get what does it mean then? So treasury bills are issued, or basically treasury bills are non-interest bearing products. So no interest is paid during the lifetime of the treasury bill. So what only thing the government announces is on the maturity date they will pay the face value. If it is 100 rupees, on the maturity date the government will pay you 100 rupees. So if you need some income to generate at the time of buying, you won't pay 100 rupees. You will pay a lesser amount. That's why we call the discount. We buy it at a discounted price from the face value. So in 91 days government promises to pay 100 rupees. To buy that product we paid only 98 rupees today, something like that. So that
It's
difference.
paid up value, no, sir?
Sorry?
That is called paid up value, no?
That 2 rupees is, yes, that's the interest income that you are, or you can consider that it as the interest income that you are going to receive. So you pay only 98 rupees to buy 100 rupees worth of the security. That means on the maturity date government will pay you 100 rupees, but at the time of purchase you pay lesser amount based on the market interest rates. So that's why we call treasury bills are discounted products.
So when you maybe trade it after 10 days, you're not going to give the full discount. Is that how it works?
Again, that depends on the market. What do you mean by full discount? So we'll come to that. So say 91-day treasury bill, you bought it at 95 rupees. After 1.5 months, you may or may not sell it at 97.5 or 98, 95. Whether you sell it at 95 or 94, 90, 99, everything depends on the market interest rates prevail at the time that you are going to sell it. So my example was, you bought it at 95. After 1.5 months, there's no guarantee that you will get 95 rupees or more. There's no guarantee. It can be less than that. That depends on the market interest rate. So we'll discuss once we discuss how to do the pricing of a treasury bill. So since it's issued by government, we consider them as risk-free instruments. What does it mean by risk-free? There is no credit risk. There is no credit risk, but other risks are there. What does it mean by no credit risk? We assume government is not going to default on that. The government will pay you the maturity value on the maturity date. But there are some other risks when you invest in government securities, or in this case treasury bills. And we use the treasury bill interest rates as benchmark rates. Say what is 3 months rate, what is 1 year interest rate. So we'll add some other premiums to the treasury bill rate. So that's why we call treasury bill rate serves as a benchmark to the market. So we discuss about maturities, and as I mentioned, there's no specified coupon, no interest income during the lifetime of the treasury bill. So issued at a discount to their par or nominal value. What is the amount that you received at on the maturity date? That is the par value or nominal value. So originally it is issued at a discount, price below than the par or nominal value. What is the price of a treasury bill? That is the amount that an investor pays to buy the treasury bill. That depends on the investor's requirement. For a treasury bill with a maturity value of 100, whether you pay 99 rupees or 98 rupees or 90 rupees or 65 rupees, that depends on the investor's required return, rate of return. So that price is calculated as the present value of the future cash flows. So this concept I have mentioned earlier as well. Present value of the future cash flows. That is the very basic concept in valuation of any financial product. So that is true for even for treasury bills. So since there's no interest income, the price that you pay, the difference between the price that you pay and what you get at the end, that is the income that you generate. So as an investor, you should make sure that provides you an adequate income. So now we'll come into pricing of treasury bills. The first one is discount. As I mentioned, so here face value. Face value is the amount that you are going to receive on the maturity date. Face value is the amount the government agrees to pay on the maturity date. On the other hand, that's the amount that you are, as an investor, you are going to receive on the maturity date. Price is the amount that you pay to buy that instrument. Okay, so that is price. So I'll switch to the board now. Face value. So remember these words. These words we will use these in other products as well. What is the face value? The amount that we receive That's the amount that the investor will receive on the maturity date, or you can say that's the amount the borrower agrees to pay back you on the maturity date. So the price is, what is price? The amount paid by the investor to buy this instrument. That's the price. So then what is the discount? Discount is the face value minus price. It's like 100 minus 98 or 99. If you buy a treasury bill, 91-day treasury bill, you will receive 100 rupees on the maturity date, but to buy that you pay today only 98 rupees. So what is the discount? Discount amount is 2 rupees. Is it clear? Discount. That's the difference between the quoted amount and the price that we pay. Clear? Is it clear? Okay. Now forget about all these things. Now tell me, now these days, even though that DIG is telling that not to go shopping, you might have done it or about to do that. Go for shopping to buy clothes for the new year. When you go to the shop, you can see a banner . What does it mean?
So you are getting a discount of 15% from the market.
You get a discount of 15%
Selling price.
of the quoted price. So when you check the small price tag, it might say 1,500. Then from that 1,500, you get a 15% discount. Now tell me, what is the discount that you receive? What is this 15%? Is it the discount? I am asking you to calculate the discount. Then what is this 15%?
It is the rate of discount.
Yes, this is we call discount rate. The amount is the discount, the rupee amount. Now tell me, if the quoted price is 1,500 and 15% discount is there, what is the discount and what is the price that you pay?
Yes.
Sorry?
225. Discount.
200. Discount is 225. Then this is
1,275.
1,275. Now tell me, how did you calculate this? How did you calculate this 225?
1,500 into 15%.
1,500 into 15%. You get 225. Then how did you calculate this price? It is the quoted price minus
Yes, discount.
1,500 minus 225. Then you get 1,275. Is there any way to calculate this price straight away from this 15% without calculating the discount and deduct it?
1,500 into 85%.
Yes. This can be done by 1,500 multiplied by 0.85. You should get the same answer. So what does it mean? You can calculate the price as, well, put face value here, times 1 minus discount. Is it clear? So you can do these calculations. So what's the big thing here? This can be done by a 13, 14-year-old child as well, isn't it? Any questions so far? No. Now tell me, 91-day treasury bill. (91-day treasury bill). For simplicity, we assume face value is 100. The price you paid is 99. What is the discount? It's a 91-day treasury bill. The face value, that means on the maturity date you will get 100 rupees. The price you paid is 99 rupees. What is the discount?
1.
Discount is 1 rupees. What is the discount rate? What's the discount rate? Okay, if you cannot answer that question, go back to our previous. Price quoted is 1,500. Discount that you get is 225. That means you paid only 1,275. What is the discount rate? So it should be 15%. We did the calculation considering a discount rate of 15% of 1,500. The price that we paid is 1,275, or the discount that we received is 225. So now the question is, if these information are given, price quoted and the discount amount is given, how do you calculate the discount rate? How do you calculate the discount rate?
225 by 1,500.
225
Divided by 1,500.
divided by 1,500 to make
Into
it
100.
percentage into 100. Then you should get 15. So remember, to calculate the discount rate, this one is the
Discount.
Divided by
Face value.
face value for the quoted price. That is how we get discount rate. So if you apply the same concept here into this our instrument, what is the discount rate that we get?
1.01.
Discount rate. .01. Why? How? I don't worry about the final answer. Tell me how to get that.
The discount amount divided by the price into
Divide by the price.
Price mean the face value.
Face value. The same thing. No?
Yeah, into 100%.
Into 100%. So if you do that, what is the discount that you get?
1%.
It is only 1%. Clear? Is it clear? I don't know why you get 1.01%. If you are
That is divided by price, right? So
this one, you get 1%. Sorry?
if you divide it by price, you get 1.0.
1.0. Okay. Should it be divided by price or the
Face value. Yeah.
face value? What should be the answer? So remember, we always discount the face value. What is the amount that we are receiving? So the discount is on top of the face value, not on the price that we are receiving. Clear? So always discount rate is applicable to the face value. So to derive the discount rate, you have to use the face value. Oh, is this okay? Is there any concern on this?
So
Is this
This is for 91 days.
yes?
91 days divided by days to maturity.
That we receive this discount only for a 91 days. But generally, for a treasury bill, the discount rate is quoted as an annualized figure. So therefore, in the financial market, we can't perform the calculation what we did here earlier. Like you are doing day-to-day shopping. We have to factor the time factor. So to make that adjustment, we get this discount rate for a period of 91 days. So when we divide that discount rate by 91 days, what we get? Discount rate applicable for a 1 day. This is the discount rate that we get for a 91-day period. So therefore we divide it by 91, then we get the applicable rate for a single day. Now we want to make it annualized. What do? We want to make it an annual figure. What do? Now we know the rate for a 1 day multiplied by the number of days per year. multiplied by the number of days per year. How many days per year?
364.
In this instance, since we are talking about treasury bills in Sri Lanka, so that is 364. So to make it a percentage, you can put this. So that's how we calculate the discount. Now you will get something. Clear? So the general equation for the discount rate is the discount divided by face value divided by number of days multiplied by basis into 100. What does it mean by days? Remaining number of days until maturity. What is basis? How many number of days per year? So that's the equation. I think it's given in the presentation.
So in the tute, we can see the 100%
Yes.
percentage. Do we want to add or?
If so to get as a percentage, you have to put it there, but generally we don't use it. Once without 100 here, sorry, you can't see the presentation now. Without this part, you will get a decimal figure. You will get for this as the answer. You will get 0.0. Then you should know this is a decimal figure. Without that part, if you plug these figures into this, you get 0.04. So this is a decimal form, which is equal to 4%. Clear? Any question? Is it clear?
Yes, sir.
Okay. Then we can modify this equation slightly. Discount rate this discount, we can write this discount as face value minus price. Correct? Discount is the face value minus price divided by face value, and the rest remain unchanged. Or you can write it as 1 minus price over face value into basis over days. So the discount rate the equation is given. I have put 364 here, considering the Sri Lankan context. Remember, the days to maturity is the remaining number of days. Okay, we'll go back. Now, in this example, we assume $91 days for the remaining maturity, because this is at the primary. You buy it at the primary auction. It is a 91-day treasury bill, but you buy it from the secondary market after 20 days. From the primary settlement date. What does it mean? So it has issued for the first settle 20 days before. Now we are going to buy it from the secondary market. What is the remaining maturity? Originally it's for a 91 day. Now 20 days has lapsed. What is the remaining maturity period?
71 days.
71 days. Now still assume you pay 99 rupees. What is the discount rate? Still the same equation. Discount divided by face value into basis divided by days into 100. What is the discount? Face value is 100. You paid only 99 rupees. Discount is 1. Face value is 100. But for how many days? Now it's not for 91 days, but it is only for
364.
71 days. So therefore, you divide it by 71 days, but the basis is 364 into 100. Will you get more than 4% or less than 4%?
More than 4%.
More than 4%. What's the answer that you get?
$5.126.
5.13.
$5.1267. So 5.13 we can say 5.13%. Okay. Is the calculation is clear? Is it clear?
Yes.
Any questions from others? Because I hear only few voices. There are about 60 attending.
Even if we get the discount rate in advance to arrive at the price, it's the same calculation that we use on a vice versa formula, no?
Yes, yes. We'll come to that. So how to calculate the from if the discount rate is given, how to calculate the price. We'll come to that. Yes, it's the reverse. So from this equation, you can, if the discount rate is given, base value is known, day counts are known, you can calculate the discount. We'll come to that.
So we are buying at 99 rupees. No?
Yes. In this example, we pay 99 rupees to buy this treasury bill. And in this example, after 71 days, the government will pay you 100 rupees. In the previous example, after 91 days, government will pay 100 rupees. Now you can see some of the questions that you asked. So assume at the primary auction, someone bought this, as we discussed, by paying 99 rupees. Even at the primary auction, the investor pays 99 rupees and bought this. Even after 20 days, he can sell it only at the same price. What has happened? Has he earned anything?
No.
No. Why? What has happened?
Discount rate is the same.
No. Now the discount rate is 5.1. Earlier it was at the primary auction for the first time, it was 4%. So that's why you bought it at 99 rupees for 91 days. But after 20 days, only 5.13.
The holding number of days is 71.
No, remaining number of days is 21. His holding period is 20 days. The initial investor's holding days 20 days. That's fine. But so he has all this for 20 days. He has held it for 20 days, but still he don't get anything more than that his investment. He gets only 99 rupees. Why? Can it be possible? Okay.
Market rates are stable.
Market rates are
stable.
Stable.
Market rates have increased.
Market rates has increased.
And the price of treasury bills has gone down.
Yes, that's why price has gone down. That the market rate has increased. So imagine for a 91 day, you get 4% only. Then what do you expect for 71 days? Do you expect more than 4% or less than 4%?
Less than 4%.
You should get less than 4% because the maturity period is now getting reduced. Remaining period is only 71 days. So it should, if the market rates were stable, it should be less than 4%. Instead, now the discount rate is 5.13%. The market rate has increased. That's what has happened. So that can happen. If the interest rates increase, you will make a loss. Unless you hold it until maturity. If you hold it until maturity, you get that difference and 4%. But what does it reflect? But still, you had some opportunity cost or loss. You invested at when the interest rate are at 4%. Subsequently, interest rate has gone up. So you lose the opportunity to invest it at a higher rate. That can happen. So by this time, maybe interest rate has gone down and you pay instead of 99, you may have to pay 99.50. Then you will get small figure than this. So that's how prices of treasury bills changes time to time. So yes.
Yeah. Now the investors holding days in a sense. Now this bill is bought after 20 days of the settlement date, right? Is that so?
Yes. No. Right. Two things. Now here we are talking about two investors now. First one is the who bought it at the primary.
Yeah.
Now he is selling it after 20 days. So for that first investor, holding period is only 20 days. The second investor who bought it at after 20 days, his holding period is he's going to hold it until maturity.
Yeah. So second investor is gaining, no?
Second investor
is gaining a profit in that case.
Not sure. Once he bought, if the interest rate further increases.
But anyway, he will be getting the same face value, no, sir?
Yeah, he will be, if he holds it until maturity, yes, he will get face value. In that sense, his rate of return is high. Yes.
Yeah, he's gaining, no?
Yes.
Right.
Okay, so, but even in the first case, if the investor who bought it from the auction, if he hold it until maturity, he gets that 4 rupees. Sorry, 1 rupee.
Okay, so thank you.
Okay.
Small thing now, when the maturity is 91 days, the rate is 4%, no? So when the maturity is 71 days, the rate becomes 5.13. But I mean, what do you call it? Both the rates will either way give the same return, no? Due to the time variance only, the rate gets different.
So we have considered that time variance. 5.13 and 4%.
Yeah. So I mean, at 91 days.
No, absolute amount 1 rupee is yes.
Yeah, that's the thing. So even 4% or 5.13, the return is the same, I'm saying.
Return in absolute terms is same.
Same, no, that's the thing. So the reason for the rate to go up is due to the remaining maturity being different.
No. The reason is that remaining maturity is being different, but the price remains unchanged.
Yeah. But price remains unchanged.
But price remains unchanged while the remaining maturity goes down. That because of rate has increased.
Right. Okay, fine. Because even the first person, even if he holds for 90 days, he has to hold for 90 days to get that 4%. But the second person will hold for only 71 days to get the same return. No.
Yes. I qualify that. First person has to hold it for 91 days to get 1 rupee. The second person has to hold it to get
71 days. Only 71 days
to get 1 rupee.
1 rupee. So that is why the second person might get a higher rate. No, in other words.
Yes. Okay. Now, for the time being, we discuss about the discount rate, not the rate of return. That's why I qualified the last statement. So both persons get 1 rupees if they hold until maturity. 1 rupee absolute terms, 1 rupees just to. But their rate of returns are different. Will you realize? You will realize it. Okay. Now we'll go into that. What is the rate of return? Now again we go back to the original statements. That means primary. Someone bought this 91-day treasury bill, paying 99 rupees. Okay. And assume He holds it until maturity. What is his rate of return? What is his income? If he holds this until maturity, what is his income? His income is same
₹1.
as discount. That is ₹1. Then what is his rate of return?
So divide discount by the price he paid to get the bill.
Yes, we calculate the rate of return. 1 divided by what? This is income. Income divided by what?
Price.
Cost.
Price. I mean, this price. Income divided by the price, because that is the amount that you invested. You earn the return on top of this amount, not on the 100 that what you are going to get. But remember, we calculate the discount on the face value. But when we calculate the rate of return, we calculate it on the price. So again, you earn this income or rate of return only for 91 days. So therefore, divide it by 91 and multiply it by 360. So therefore, in general, rate of return is income, or you can say in this case discount, divided by the price, that is the invested amount, into basis, divided by days into 100. Now you can calculate what is the rate of return. What is the rate of return for the first investor if he holds it until maturity? You can calculate the rate of return for the first investor, assuming he holds it until maturity. So we can get it by substituting numbers. What's the price he paid? 99. He get an income of ₹1. What is the rate of return?
4.04.
4.04%. So it should be more than the discount rate. What is the difference between this equation and the discount rate equation? Only this part. This is income, or the discount is same. For the rate of return, we have price here. For the discount rate, we have face value. The face value is always higher than price. So when we divide the same number by a higher number, we get a lower. So therefore, discount rate is always less than rate of return. Clear?
Yes, sir.
Okay, now this is 4.04. Now assume this investor sold it at 99 for the second investor after 20 days. What is his rate of return? The investor who purchased this treasury bill from the primary auction by paying 99 rupees and sell it to another investor after 20 days at 99 rupees. What is his rate of return? Is there any income for him? Is there any income? He bought it at 99. He sold it at 99. So income goes to 0. Then everything would become 0. So in that example, the first investor, he didn't earn anything. His rate of return is 0. It is a sort of extreme event, but that can happen because the interest rate has gone up. Now, assume the second investor who pays 99 rupees to buy this when the remaining maturity is only 71 days. What is his rate of return?
5.17.
5.17. How do you calculate that? Still the same equation. He bought it at 99. Once he hold it until maturity, he gets 100. So the income is 1 rupees. Investment is 99 rupees. 436 to annualize 364 days, but he earns that income only for 71 days multiplied by 100. Again, you should get more than 5.14, whatever the discount rate that we calculated earlier. What was the answer?
5.17.
Correct. So this is the rate of return for the second investor, assuming he holds it until maturity. If the first person holds it until maturity, it was only 4.4%. Now you can see, even though the 1 rupee, the same income they earn, their rate of returns are. So don't go by the absolute figure. You have to think about the rate of return. So say you invest 1,000 rupees and after 1 year you earn 10 rupees, and you invest 100,000 rupees and earn 10 rupees after 1 year. Is it the same? Invest 1,000 rupees and earn 10 rupees. Invest 100,000 rupees and earn 10 rupees. Which one you select? Definitely you go for 1,000 rupees investment, because it gives you a 1%, sorry, 0.1% return. In the other one, it will much less rate of return. So don't compare absolute values. What you have to compare is the rate of return. And for the same period, if you don't do this annualization, you would get some different figures. Is it clear? Any question? Any question?
One thing, now generally in market terms, you call the yield as the rate of return, is it? Discount rate, sorry.
No. in the market we use the yield.
Yield is referred to the discount rate, is it?
No, yield and the discount rate is again two different. We'll come.
So yeah, okay.
Indeed, this 4.04% is the yield.
So that's the rate of return, no?
Yes, 1.517 is the yield. Rate of return is same as yield. But you can use either one to discount. We'll come to that. Before we go into that, we'll understand this a little bit further. Assume 91-day bill by price is 100. Sorry. Price is 99. Face value is 100. After 20 days, investor sell it at 99.50. $99.80. At these two instances, calculate the rate of return. So we'll do this after the break, but during the break you can try it. Initially it was issued at this price, but after 20 days it was sold at 99.50, scenario 1. In scenario 2 it's at 99.80. What is the rate of return in these two scenarios for the investor who bought it from the primary option? So we'll discuss after the break. We'll take a break now. Before we take a break, if you have any questions, you can ask now. If you don't have any questions, we can take a break about 15 minutes. Case 1, for scenario 1, price is 99.50. So what is the income? 99.50 minus 99.50 cents. Then what is the rate of return? Income divided by the price into basis divided by number of days into 100. What is the income? 50 cents. 0.5. The price he paid 99. Number of days 20, because he held it only for 20 days, and annualized the basis is 360. What's the answer?
9.19. 9.14.
9.14.
9.1.
9.1. 9.19.
9.19.
The answer is 9. So now you can see initially, if he hold this until maturity, he get only a 4.04% return. He bought it at 99 for 91 day. If he holds it until maturity, his rate of return is only 4.04, but he is selling it at 99.50 after 20 days, and his rate of return 9.19. What would be the reason? What is the reason behind? What would be the possible reason behind this gain?
Interest rate had gone down?
Interest rate has gone
Down.
down. Exactly.
Yeah.
When the interest
That
rate
one.
has gone down,
Less discount rate.
less discount, the price goes up. So that's why even for 20 days, he is realizing 9% annualized return. So if you
Excuse me, sir.
yes,
So 0.5 should be divided by 99.5. The face value is 99.5.
no. I am referring to the first investor who bought it at 99.
Okay.
The price he paid, and he is holding only for 20 days.
Yeah.
Then what is his return? His income is only 0.5. His cost is 99, and that's why 20 days. For,
Yes,
for the second investor, what would be the rate of return? Then you have to divide it. Then you have to, in that case, for the second investor, you have to divide it by
Swatch 1 days.
1. Then you get much lower than 4%. What's the answer?
2.58.
2.58 probably. Yes. So now you can see that's why interest rate has gone down. That's why the new investor earned only 2.58 compared to this 4.04. Even for a small drift in the number of days, there cannot be this much huge change unless the rate has moved down.
So it should be divided by
Sorry, yes, 99.
99.5.
99.5, yes. But I think this answer is based on that. Let me check it. 0.5 divided by 99.
2.57.
2.576. That means 2.58. So you can do the same here. With this, you will get a, for the first investor, you get much higher rate of return. And for the second investor, much lower rate of return. I think you can do that. Any question?
So second investor is earning very less interest.
Yes, because now the interest rate has gone down.
The market rate should be lesser than that.
Market interest rate is yes.
Market interest.
Huh?
Okay.
I didn't hear that.
Okay, sir.
No question. Okay, I will show. So the discount is face value minus price. Discount rate discount over face value into basis divided by base into 100. Rate of return, we can call it as the yield, is discount divided by price basis base into 100. So these are the three key equations we discussed so far. Is it clear? Is it clear? These three equations. So I think now you have some understanding what are the concepts behind these. Why discount divided by face value? Why basis divided by days? And why do we multiply it by this part? Things like that. Without just remembering the equation, better to have that understanding. Then you can easily put these figures. For the even to remember the equation, that could be easy. Now we'll do the reverse calculation. What does it mean? When the discount rate is given, how to calculate the price in treasury bills? How do we do that? Say face value is 100, 91 days. Discount rate 5%. What is the price? Face value is 100, 91 days treasury bill. Your discount rate is 5%. What is the price that you are going to pay to buy this bond? First thing what you can do, calculate the discount. How do you calculate the discount? Face value into discount rate, isn't it? It is face value into discount rate. But again, this has to be adjusted for the time. This is for 364 days. What would be for 91 days? Then you get the discount. So therefore the equation is discount rate days divided by basis. So face value is 100, discount rate is 5%. Face value is 100, discount rate is 5%. 91 days divided by 360. 5 divided by 4.
98.75.
Discount is 1.25. We are calculating the discount. Discount is 1.25. Then you know what is the price. price is face value minus discount, 100 minus 1.25, 98. Price equals face value minus discount amount, that is 100 minus 1.25, you get 98.75. Clear? Any question? So therefore we can write discount equals face value into discount rate into base divided by basis. Clear? Any question? Can we leave this? So we can combine this and these two to get us the equation for the price. So from this equation, we can write price as face value minus discount. Is this clear? From this equation, the equation I got at the bottom to get the price, when we know the face value and the discount, price equals face value minus discount. For this discount, we can use this equation, face value minus face value times discount rate into base divided by basis. Now the face value is common. We can take it out. Face value 1 minus discount rate into base over basis. That is price. So instead of calculating discount and deduct it from the face value and finding the price by following two steps, instead of doing that, we can use this equation straight away to calculate the price when the discount rate is given. So price equals face value 1 minus discount rate into base over base. Remember, whenever you put discount rate, it has to be a decimal figure. Is it clear? Or any questions? Any questions? Are you with me?
Yes, sir, got it.
Okay. Then let's move to the next one. We calculate the yield or the rate of return. Rate of return we can say as the yield. So I'll use the word yield now. Yield equals discount over price into basis over base. This is the equation without this 100 part. Okay. What is discount? Face value minus price over price into basis over base. Correct? Is it clear? Instead of discount, I wrote the original version. What is discount? That is the face value minus price. So in that, we can take this basis part to the left hand side of this equation. Then it would become yield into base divided by basis equals, I break this into two parts, FV over price minus price over price. Is it clear? Face value divided by price minus price over price, which is price over price, which is equal to 1. So therefore I can write it as 1. Now I can take this minus 1 into this side. Then yield over base divided by basis plus 1 equals FV over price. From this, we can write price equals FV over 1 plus yield into base divided by basis. That's the one I mentioned earlier. Someone asked whether to use the yield or discount rate to get the price. You can use both. This is the equation. If you know the yield, how to calculate the price. This is the equation. If you know the discount rate, how to calculate. In this case, remember face value times 1 minus discount. Here, price equals face value divided by 1 plus yield. Yield adjusted for the time period. Here, discount rate adjusted for the time. Clear? Okay, now assume, now we'll do an example for this. Any questions so far? So don't worry about, I'm not asking you to remember all these steps to derive this equation, but for more clarity without giving straight away this equation, those who can understand how to get this equation. All these are interlinked. So how can you move from one equation to another? When you have that understanding, you know inside out. That's why I did this. So, but you don't want to remember or need to know about this, forget about this, then remember the equation, but you should be able to correctly interpret all these. Any question? Any questions?
Up to now, no, sir.
No. Okay. Then we'll do an example. Again, take a 91-day treasury bill. Face value 100. You need for required rate of return. Your required rate of return, which is same as yield, is 4.04%. What would be the price? There's a 91-day treasury bill is going to be option. You need a 4.04% return. Then what's the price that you are going to pay? We can use that equation. What is that? Price equals face value divided by 1 plus yield into days divided by basis. Face value divided by 1 plus yield into days divided by basis. What is the face value? Face value is 100. 1 plus, what is the yield? The rate of return. You require 4.04. So 4.04 divided by 100. Number of days, 91 days. Divided by 360. You should get something close to almost 99. Any question? Any questions? No. So that means we covered everything about treasury bills. And remember, the same concept, the same set of equations are used in commercial papers or any other discount product. Any other discounted product, the same concepts are. There's no reason to change this. Any question?
When you say any other product, it means for any other zero coupon product.
Even for zero coupons products, there may be slight changes because of it's more than 1 year. But still, this concept is applicable. Other than this, the way we calculate the yield is different because it's more than 1 year. Then the compounding frequency is different. So this convention is called money market yield convention. So the way that we use 1 plus yield into number of days divided by basis. But when it comes to more than 1 year, we use that present value equation, this one, future value 1 plus Rn. We use this one when it comes to more than 1 year period. And even in this, you might remember when the frequency is more than 1 per year, we divide this 1 plus Rm and M into N. This is the concept that we used in a zero coupon bond. But all other money market instruments, we use the same concept in commercial papers. All other money market discounted products, sorry, like commercial papers. But whenever there's an interest component, we don't use that discount product. But to calculate the interest, this part will be used as it is. Any other question? Any questions? So now you can go through the handout and see with regard to treasury bill whether we have mistake. So this equation we discussed, and one new term is here, holding period yield. That is the rate of return, but without annualizing it. Say for a 10, if it is for 10 days, what is the rate of return for 10 days? But very rarely we use that. We use the annualized return. So this is price. So after including discount rate and days to maturities again. So now you should be able to perform this calculation. This is the relationship between yield and yield, face value, and price. From that only we derive this price equation. This one. If we calculated yield, we calculated price if we know the yield, but this is to calculate if you know the face value and price, how to get the yield. But it is nothing but for the discount we write FE minus P. That's how where we started to get this equation. Okay, now looking at this equation, now you tell me what would happen to the price if the yield increases. What would happen to the price if yield increases?
Price should go down.
Price will go down. If days to maturity increases, yield is constant, but days to maturity is increases. That means same yield but two different maturities. What is the relationship in the prices? The longer the maturity, lower the price, because when the number of days increases here, this part would be high. If we divide by a higher number, then you get a lower price. If the yield decreasing, price is increasing. Now, those are clear. Is it? Or do you have any questions? This is a very simple example because it considered a 1 year. Then this become 1. But you have to work out only with these figures. It is very simple. And what we discuss is little bit advanced than this. You can try out these. All these you can work out. You try by yourself. Then if you have any question, please ask later. This equation, the relationship between yield and the discount rate. From the set of equations that we had, or from this, FE minus P is the discount. We can replace discount with the equation that we get with the discount rate. Then after doing some manipulation, we can get this relationship. What is the relationship between yield and discount rate? But remember, always yield is higher than discount rate if the rates are positive. Clear? If the rates are positive, yield is always higher than the discount rate. This case, if the treasury bill is sold prior to maturity, we did some example. Still the same set of equations that you have to use. Instead of face value, here we use the selling price. What is the price that you are going to sell it, and P is the price that you purchase. Any questions before we move into Fed funds? Okay, is it difficult?
Excuse me, sir. Are there any books or question with answer papers available at IBSL related to those areas?
There are books in the library, but I'm not sure whether there are questions and answers related to this. Especially this, only this. The books which are discussed about interest rates or interest calculation or quantitative techniques related to finance. Those books, you will find these equations or the theory and the question, theory question, sample questions and answers, and practice questions as well. But I'm not sure whether there's anything published by IBSL, especially on this.
And another one thing.
Yes.
In DABF, there are 3 subjects called financial management, financial market operations, and investment banking. So those 3 subjects are containing these kind of same topics. So if we purchase those past papers and answers, and if we practice those, that's also good, no, sir?
Yeah,
For this one.
that will help. Yes.
So
Wherever it is, if you can find same sort of questions, yes.
So those are the 3 main subjects contain the same topics. So
Yes, yeah. But maybe in different angles. Not showing the financial market operations or somewhere. Whether they have the focus on the calculations or how do you trade in the market or that aspect. So maybe slight deviations, but the basic concepts, yes, should be. But yes, no harm of doing that. It would be beneficial for you, definitely.
Thank you.
In that previous slide, the relationship between the yield and the discount rate. Can you just revisit that part, please?
Yes.
Yeah.
This equation.
Yield and the discount rate relationship that you are talking about.
Yes. So you can see here, yield is equal to face value minus P. This is discount. This is discount. Can you remember we had the equation for the discount with the discount rate?
Oh yeah, that is the discount amount, no? Face value minus the price.
Yes, FV minus P means the discount amount, but we can calculate the discount amount using the discount rate.
Okay.
Substitute it here, and for the P also we had the equation. Price we can calculate from the discount rate straight away. So substitute that here, then these face values will be cancelled out and you can get this equation. I don't want to do it. I know there are some people, those who are not very familiar with this manipulation of equations, so I don't want to bother them. But if you really need, we can do that, as we did in the previous one. I'll tell you. You try it. I'll do these sort of things. I'll do it on a Word document or somewhere else and upload it. Then anyone who wants to go through that, you can go through. That would be a good solution. Anything else? So if not, we'll move into Fed funds. As I explained, it is the US interbank market. It's the US interbank market. They call it federal funds because in US, the Federal Reserve Bank is the central bank, and there are sort of branches in different states. They have different branches. The banks in that state or under that branch, they do deals with or transaction with that branch. Federal network. So, and every bank maintains a account with one of these Fed banks. Then they transfer money from one bank to another bank through that Fed accounts. So that's why it's called federal funds, because you move funds that you have placed with Federal Reserve Bank, FRB. That's why it's called federal funds, but it's not the central bank funds. It is the commercial banks funds placed with the in their accounts and move among themselves, or lend and borrow each other. So the main characteristics are the transfer of immediately available funds. So whatever the funds that they have idle in their accounts with the maintained with the central bank or the Fed Reserve, they transfer and they lend it or borrow it for a very short time horizons, mostly overnight, and it is unsecured. That means you just lend to the other party, you don't get any collateral or nothing. So that's why it says unsecured transfers. The equivalent of that in Sri Lanka is the interbank market. Or in any country, there are interbank markets in each country, because they want to lend and borrow each other. Even in the Fed funds, this is what happens. Commercial banks, they maintain reserves deposit within the central bank. What is that reserve we call? What's the name?
SRR.
SRR. So for that, commercial banks maintain an account with the central bank. So there may be excess funds more than the reserve requirement. You may have funds in that account. What do you do? If you keep it with the central bank, you don't get, if you keep it in that account, you don't get any interest. So to get some interest, whatever that excess funds, you lend. There may be some other banks, those who have deficits, they want to borrow, so therefore they borrow from the banks with surplus. That's what happens. That is the interbank market basically. In a way, this is the origin of the money market. To maintain that, commercial bank starts to deal with central bank, borrow funds from central bank. Then they started to borrow from other banks. That's how the money market has developed. So the basic or the main requirement of the borrowing in the interbank market is to meet your reserve requirement. First thing that you have to do is to meet the reserve requirement. If you don't have sufficient funds in your reserve account, as a bank, we have to fund it. So the main reason is to maintain that. I'm not going to discuss in detail how to maintain that SRR. Some of you may know there's a way. The requirement is calculated on a 1 day, then you have to maintain it on an average basis for another 14 days, something like that. There's a separate set of guidelines. I'm not going to discuss it at this level. Maybe in the ALM and the Treasury, where we may discuss those. So, however, the main requirement is to meet that liquidity or the reserve requirement of commercial banks. So, therefore, banks deals in big volumes, large volumes, and the period may vary from overnight to maybe 2 weeks or something like that. Very rarely go beyond that, because your cash flows are varies in you need not to lock for a long period. And the interbank deposits you cannot trade. Interbank products you cannot trade. It is just an agreement between two parties and non-negotiable. You cannot transfer your obligation or your asset to another bank. Only thing you can do it, if the other party agrees, you can early settle the transaction. That's the only thing that you can do, but generally you don't do that, because then definitely in a transaction there will be one party is benefiting, the other party is incurring a cost. So the whenever the rate moves in your favor, you will try to cancel the deal or the transaction, or early settle the transaction. So then it is not good for the other party. So that will happen other way around as well on a future date. So therefore you don't do that generally. Once you enter into a transaction, you hold it for that period. And therefore for the interbank market, there's no distinct or the difference between primary market and secondary market. There's no such thing. It is just a transaction between two parties, not that one bank is issued and other bank is investing at the primary market. There's no such concept in the interbank market. In the interbank market, there are very common maturities, commonly used maturities: overnight, Tom next, spot next, and spot week. I'll explain in the coming slides what each and every of these, or meaning of each and every of these maturities. Overnight means you borrow today. That means the fund transfer is happening today itself. You will receive funds today if you are a borrower. If you are a lender, you transfer your funds to the borrower today itself, and repayment occurs on the next day. So you lend or borrow only for a single day, starting from today. It's only for a single day, but starting from today. So that is called overnight, just for a single night. Oh, we borrow cash just for today. Yes.
Yes. What is the purpose of having such a borrowing? That is to maintain a central bank ratios or balances?
Yes. Major concern is to maintain the reserve requirement. If you cannot meet your reserve requirement today, you borrow it from another bank. But if you see in your balance sheet, there's a deficit for maybe 5-6 days consistently, then you may borrow for a long period. But generally, what really would happen, you don't have sufficient funds today, but tomorrow you may have excess funds, or you may have enough funds. So therefore you don't want to borrow for a longer period. You just borrow for one day to meet that SRR. Clear? Have I answered your question?
Yes, clear.
Oh, okay. Overnight, is it clear? No, just for a one day starting from today. So that means you agreed the transaction and settle the transaction. That means initial fund transfers are also happening on the same date, today itself, not in our. So in our terms, trade date and the settlement date are on the same date, with the maturity falling on the next day. So you do the transaction on 9th, you receive, or if you are a borrower, you receive funds on 9th. If you are an investor, you deliver funds on 9th itself. On 10th, overnight basis, on the 10th, you pay with the interest or you receive with the interest, depending on whether you are a borrower or a lender. So that is overnight. Tom next means you enter into the transaction today. Today is the trade date, but you place the deposit or you receive it tomorrow, but for a 1 day again. You receive funds tomorrow, but for a 1 day. That's why it says Tom next. The funds transfer is happening tomorrow and reversal is happening next day after tomorrow. Is it clear? So 9th is the transaction date. Initial fund transfers are happening on tomorrow, 10th, and the maturity falls on 11th. Tom next. Remember the same jargons, same terms we used in foreign currency or FX transactions as well. Overnight, Tom next, and spot next, and things like that. So is it clear what does it mean by Tom next?
This that is interest will be calculated from 9th to 11th.
No.
This 10th.
Since 10th, interest rate will be calculated only for a 1 day.
1 day, no? Right.
Even in this case, interest rate is previous one, interest rate is calculated only for 1 day, because you receive funds on 9th, you pay it back next day. So only 1 day. You borrow funds only for a 1 day. The difference here is when do you enter into the agreement and when do you borrow. The real borrowing is happening. In this case, the real borrowing is happening overnight basis. Real borrowing is happening on the same date as you entered into the transaction, that you agreed the transaction. But on the Tom next one, you agreed today, but the real borrowing is happening tomorrow. You repay it back.
Yes. What is the basis of having a two different scenario? That is means overnight one Tom next.
Few things.
On a day.
Yes, few things. Now you can predict your balance sheet for few days ahead. Then you see you have a deficit on 10th. Tomorrow, not today. You have enough funds today, but you are short tomorrow. If you expect that would happen tomorrow in many banks, and if the interest rates going up, that would happen tomorrow, it would be better to enter into the transaction today, lock the rate today. Lender also thinks other way around. That can happen. You don't want to take a risk, wait until tomorrow and do the transaction. You may not be able to borrow from the market. If everybody is in a deficit, interest rate will go up. That things happen. And if the volume is large, if it is a huge volume, you don't want to wait until last moment. So this is about managing your cash balance. Sorry?
So this is beneficial for the borrower.
This is basically for?
This is Tom next is beneficial for the borrower, right? This is beneficial.
No, not really. That depends. That can be. That depends on the market movements. So for a transaction, there should be two parties. No, even for a Tom next, there should be a borrower and a lender. Borrower borrows thinking, if I wait till tomorrow, the cost of fund would be high. Lender thinks other way around. That's why everywhere that's what happened. Otherwise, there won't be any market. Borrower always thinks about his risk. If the interest rate goes up, what would happen? Lender always thinks if the interest rate goes down, it is not good for me. So Both parties prefer to fix the price early as much as possible. So that's what happened. Otherwise, if it is always in favor of the borrower, nobody will lend. No, they will wait until next day. It's not always in favor of the borrower. That depends on the market move next day. Sorry? I didn't hear that question.
If the borrower can enter into a transaction, it will be difficult.
If the borrower can enter into the transaction, I didn't get the whole question.
And find the lender. Yeah, if he finds the lender, then it's beneficial for him.
Not sure. Not sure.
If the borrower
Say
can
you.
find the lender, so if he can borrow a lesser rate.
At the time of entering into the transaction, you think it's lesser rate or the rate is okay. So assume today you enter into a transaction to borrow on Tom next basis at 5%. So there, what does it mean? Tomorrow you borrow funds and pay 5% interest and mature the or repay the borrowed amount and the interest on the second day, 2 days after today. What would happen by tomorrow? When you go to tomorrow, interest rate falls down to 4%. If you have wait to do an overnight transaction, you could have borrowed at 4%, or it can be 6%. We never know that what would happen, but your expectation is that rate will go up. That might be your expectation, or it may be the interest rate remains same, but you have your deficit is huge. You don't want to go to the market at once with all those things. You will try to collect funds gradually. So that also can happen here. Is it clear now?
Okay.
Okay. Shall we move to the next? Spot next. You know what does it mean by spot? Generally, we call spot is after 2 days. So from the trade date, if you enter into the transaction today, the agreement, enter into the agreement today, it will settle after 2 business days. Then the spot next means you borrow or place the deposit on the spot date and matures it on the next date. That's the spot name. Spot next. Transaction date is 9th. First settlement date is 11th. Spot date. You borrow or lend on 11th and mature the transaction on 12th. If you borrowed on 11th, you repay it on 12th. If you lend it on 11th, you receive back it on 12th. That is spot next. Remember all these three: overnight, Tom next, spot next. The borrowing period is only 1 day. You borrowed only for a single day. But what matters, your transaction date is same, but the real borrowing date and the maturity date is vary. Depending on that only, this classification, whether it's a overnight, whether it's a Tom next, or whether it's a spot next. Clear? Any questions? The other one is spot week. instead of spot next, that means you borrow deposit on the spot date. For a in the spot next, you borrow deposit for a 1 day over spot, but in the spot week, you borrow or lend on the spot date over a period of 1 week. So 9th is the transaction date. Then the first settlement date would be 11th, spot date, and the maturity falls on the after 1 week period on 18th. That is spot week. Any questions? Those are the very common maturities in the interbank market. So
then this spot week, we are considering the only the calendar days, no, even though there is any holidays.
Yes, yes.
We think. Then what would happen that 18th is holiday?
Then it's a holiday, then we follow that modified following convention. We put it on, push it on to 19th.
19th.
But these are very common. But if you want any others, we call broken dates. So 11th is the spot date. 18th is a holiday. You think it's better to, I don't want to funds to keep until 19th. I can settle it on 17th. So you can have a maturity date on 17th. Then it may not call as spot week, but you can have anything. Borrow over spot and pay after 3 days or 2 days. So maturity date you can decide, but then it would be just a deposit for 3 days or 4 days. We call them broken days. Then the commercial paper. Sorry, any other question before we move into these commercial papers? I don't have too many things to say here because commercial papers, as I mentioned, this is the treasury bill equivalent, but issued by the corporates. So to fund their short-term requirements, they use commercial papers. Again, these are tradable instruments and discounted product. Commercial papers also issued at a discount. So what the borrower promise is to pay the face value on the maturity date, no other interim cash flows in between issuer and the lender, or the issuer and the investor. So almost same as the treasury bill. So, but other thing is you take the credit risk of the corporate. It's not like the government. In that we mentioned it's risk-free from the point of view of credit risk. In the treasury bill, there's no credit risk because we assume government can pay this. But commercial papers, there's a credit risk. The corporate who borrows this fund may not be able to pay funds on maturity. So therefore, credit risk is there in commercial papers. But if I go back to treasury bills, I mentioned we call it as risk-free, but it is only from the credit risk perspective. What other risks are there? Based on
sovereign risk?
Sovereign risk means against the credit risk, no. That is the whether the sovereign, the government will be able to pay it.
Interest rate.
Interest rate. You experience that when the interest rate changes, value of the price changes. The investor who bought it at 99, after 20 days also he had to sell it at 99 just because of the interest rate has increased. So that is the interest rate risk. That risk is there. So whenever we say government securities, including bills and bonds, both are risk-free, we are referring only for the credit risk, but the interest rate risk is there. But when it comes to commercial papers, both the credit risk and the interest rate risk are there, because corporates can default. And the issuance, that depends on their requirements. So therefore, there's no rule to say that maturities will be 91 days, 364 days, or 182 days, or something like that. There will be any irregular maturities depending on their requirement. So then the pricing is almost same. So sorry about this. This par is the par value, the face value that you are receiving, 1 minus discount rate into n divided by 360. You can see this is the same equation that we used. Face value into 1 minus discount rate into number of days divided by day basis. In this equation, I have assumed for year there are 360. That again, that depends on the market. Even in Sri Lanka, I think even corporates, they assume 364 days. But in international markets, they assume, in the money market, they assume 360 days per annum. So they use 360 days. So as I mentioned earlier, all the equations that we used for the pricing of treasury bills can be used for commercial papers. Only thing is that change is the day count convention. What is the basis? Whether they go with actual 360, actual 364. That is the only difference. That depends on the market. In different markets, they may use different money market conventions. This is the one I mentioned. Commercial papers unsecured. There's no collateral given when you purchase a commercial paper. It is just a plain lending, naked lending. So no security. So you take the full risk, credit risk of the corporate. So therefore, you add some credit risk premium to the interest rate. So you will discount these things at a higher rate than the treasury bill. Certificate of deposit. This is slightly different. Let me see. Okay, I'll explain this. Now you can see the board. Assume you buy a certificate of deposit with 5% interest rate. In a certificate of deposit, there's a quoted interest rate because it's a interest bearing instrument. Assume the interest rate is 5% for 6 months, and for simplicity, we assume 3360-day count. The principal you place is say 100,000 for a 6-month period at 5%. Day count convention is 3360. What is the maturity amount? If you hold this for a 6-month period, what do you get? You get principal plus interest. Simple. What is the principal amount? 100,000. What is the interest amount? 100,000 into 5%. But for a 6-month period on 3360 day count basis, for 6 months there are 180 days. Divide by 360. What's the total amount? correct? 102,500. Clear? Any question? This is just a simple interest calculation based on 3360-day count basis. So this is the nature of the certificate of deposit. You place the principal value with the bank. The bank will give you a certificate saying that we have borrowed this much amount for this period and the interest rate is 5%, and we'll calculate the interest based on this day count basis. So on the maturity date, we will pay you this much. So then what's the difference between the fixed deposit that we talk and this one? There's no. And remember, in the morning, I explained the certificate of deposits. There can be two type of certificate of deposits. Tradable one and the non-tradable one. When it is the tradable one, sorry, non-tradable one, nothing more than that. You place money with the bank, get the deposit, wait until maturity, and present the certificate and get this back. But in the tradable one, the story is different. Now I am going to add that part. Say after 1 month. After 1 month, you don't want to keep this. You want to sell it, and you need, for some reason, you need cash. This is the investment that you have. This is a tradable one. So you want to give it to someone else and get your money back. Now what do you do? Now assume, what is the remaining maturity of this? What is the remaining maturity?
5 months.
5 months. It's only 5 months. Now what matters is, what is the 5-month interest rate? By this time, what is the 5-month interest rate? Now say it is only 4.8%. 5-month interest rate. After 1 month from the original transaction, the remaining maturity is 5 months. By that time, 5-month interest rate is 4.8. Now, how do you calculate the consideration? That means, what is the amount that you will receive, or what is the amount a possible buyer of this FD or the CD will pay you? What is the amount an investor will pay you, or if you are an investor, what is the amount that you will pay to buy this instrument? How do you calculate? Now the thing is, what the original borrower, the bank, has agreed to pay this much on the maturity date. The bank will pay 102,500 on the maturity date. Now, since we have moved 1 month away, from now, after 5 months, bank will pay this amount. You know what you are going to receive at the end of 5 months period. This is T0, this is 5 months. You will receive 102,500. So what is the amount that you pay to buy this instrument? How do you calculate it? What you have to do, you have to calculate the present value of this cash flow. That's it. Calculate the present value of this cash flow. But remember, this is not a semi-annual period or something like that. This is 5-month money market. calculation. In that, what we do, whatever the face value, that means whatever the maturity amount that we receive, discount at using this money market convention. So if we put the numbers, it will be face value or the maturity proceeds would be 102,500 divided by 1 plus, what is the yield now? What is the required rate of return now? For a 1 month, 5 month period, you need 4.8. 4.8 divided by 100. 4.8 divided by 100. How many, for how many days? For how many days?
150.
150 by 30 into 5. 150 divided by, what is the basis? 360. We assume per year there are 360. Whatever the answer you get here, that is the consideration that you pay or you will receive in the secondary market for this certificate of deposit, tradable one. If it is an untradable one, nothing to do, no need to do these things because you cannot transfer, you cannot sell. Is it clear the concept? Calculation again, almost same like a FD in this part. Sorry, not FD, Treasury bill. Treasury bill face value, we know the yield, we discount it. Then we get the price. Any question? Is it clear how the certificate of deposits are traded in the secondary market? That's the only special thing in that. Others almost the same. So, yes. If you don't have any questions, we'll stop here.
So a small concern.
Yes.
I just remember when it comes to commercial papers, suppose the corporate is not in a position to repay on maturity. What are the steps the depositor can take to recover that? Is there a legal process or something like that?
That depends on the governance of the issue. Definitely, you will go for that. Sometimes there may be a trustee who is handling that. Yes, definitely based on the covenant. If there's nothing in the, then you have to go for a legal proceeding. Yes, it's a default. Then it's a like sort of liquidation or things like that. Definitely you have to follow that.
Right.
It's a default. Either you have to discuss with them and come to an agreement to extend it for okay, we'll give another 6-month period, and we'll, for that we need this much of interest rate, repay it, or either that means either you can restructure it or go for legal proceedings. But since it's issued in the open market for many investors, that has to be done through the trustee, or there should be a proper way of doing that. Not for one investor you restructure or you pay for one investor, not for others. You can't do that.
Right, sir. Then where the corporates publish their commercial paper issuance is it done through share brokers, stock brokers?
Generally in Sri Lanka, they list it in stock exchange.
Stock exchange through brokers.
Yes, basically when they issue, they have to go through a investment bank. So the bank will do the investment bank role, place the investment bank role. So they do all these things.
So then, sir, the history, is there any default cases for commercial papers which is issued by corporates, the major cases?
You mean whether there are any issues or the historical cases?
Events, yeah.
I'm not sure.
All right, sir.
In Sri Lanka, yes. In the international market, definitely there will be. In Sri Lanka also there may be, but not in the very recent past. Right.
Right. Okay. Thank you very much, sir.
Okay.